Hey friends, welcome back to another episode of Making Sense of Your Market. Today it's Friday, Cinco de Mayo. Getting ready to head downtown Edmonds with my wife in her cookie truck with Jenny Cookies Bake Shop to sell some cookies for Cinco de Mayo and have some fun right across the street from Las Brisas, our favorite Mexican restaurant in Edmonds. But real quick, I wanted to make this video because I've got a lot of people already starting to ask me about 15-year fixed rate mortgages versus 30-year fixed rate mortgages. Now, I believe this is a properly timed conversation because I believe that in the next 6 to 12 months, interest rates are going to be down and I'm going to be able to refinance a lot of our clients that had higher interest rates over the last couple of years since the Fed decided to raise the Fed rate to combat inflation and all of that stuff. So I want to start talking about this now versus it being, next year and maybe a little bit too late. Plus, I think this is just really helpful information. So I get a lot of questions around which one is best. Dan, which do you believe is best, a 15-year or a 30? And it's not always what I believe because that's not really what matters. What matters is, does it fit your financial situation and your financial tendencies? That's the most important. And so I'm going to share with you today in like 2 minutes or less the conversation I have with all of my clients when they ask me about a 15-year versus a 30-year. But every single week when I make these videos, at the very beginning, I talk about interest rates. Are they up or are they down week over week? And they're down a little this week because the Fed came out this week and relieved a lot of anxiety with investors and just in the economy and basically said, hey, we're done raising the Fed rate. We're just gonna let inflation run its course and we'll let this thing play out. But for now, we're done. And so that's good news. Investors like that, and mortgage rates dropped as a result. Not a ton. We're still in the 6.3 to 6.5 range, but it's better because we were flirting with 6.6, 6.8 a couple of weeks ago. So that's good news there. Let's talk about the question, 15 versus 30. So the first thing I want to show you is I'm going to bring up a report right now, and it's going to show you a comparison between the monthly payment of a 30-year fixed rate mortgage and a 15-year fixed rate mortgage. And what you're going to see here, it's about a $600,000 loan amount at 4.5% for a 30-year fixed rate and 3.625 for a 15-year. You can see the difference is about $1,270 a month in your monthly payment. All right, so how I address this scenario with my clients is, if you are risk adverse, meaning I don't like investing in the stock market, I'm not real great with my money relative to having money left over every single month and setting it aside or investing it, or I don't want to invest it, then a 15-year fixed rate mortgage is a really good option for you because it solves for both of those problems, okay? You put your money and you go all in on your home and your home's equity, and in 15 years, you're sitting on a lump of equity. Now, one of the reasons why I don't like 15-year fixed rate mortgages is because you do have that big lump sum of money every single month that you're just throwing into real estate, which isn't bad if you're like personality type A that I just talked about. Personality type B is what I like to talk about, and this is because this is what I've practiced, where I go with a 30-year fixed rate mortgage, okay? The difference between a 30-year and a 15-year is about $1,270 a month in this scenario. I take that difference and I invest it in the S&P 500 index, or I invest it with my financial planner. I get that working in a different market, in a different investment vehicle. So now I have two different investment vehicles. I have my home that is going up in value to the tune of, let's just say on average, 7 to 9%. And then I have the S&P 500 that's going up to the tune of 7 to 9% as well. Look at this. After a 15-year period, if you went with the latter that I'm talking about, it involves a little bit more, I don't want to say risk, but you could say risk, but it involves a little bit more work. At the end of 15 years, you have enough money now in that investment account to pay off your mortgage if you want, but you're 15 years into compounded interest, right? So you can let that snowball continue to grow and develop and just continue to increase your net worth there. I like that option because look at this. At the end of 15 years, you have a greater net worth as well using that option versus just paying down your mortgage or just going with a 30-year mortgage and letting that money sit in a savings account. So that's how I answer the question. If you're personality A, that is not necessarily great with your money, doesn't like investing for whatever reasons, then go with a 15-year fixed rate mortgage, and in 15 years you owe zero, and you're sitting in this particular scenario, you're sitting on a $2 million asset, okay? The other scenario, you get your money working for you in 2 different pools, and you come out in 15 years with options, and I like options relative to your money. So if you have any questions on this, I want you to reach out to me. I hope you have a great Cinco de Mayo weekend, and I look forward to bringing you some more information next week. Bye for now.